Welcome to the 35th installment in Trading Strategy Guide's Trading Education Series. Today we're going to dive into a great trading technique that everyone should include in their trader's toolbox. I'm talking, of course, about multiple time frame analysis. Stay right where you are. Hi, this is Tim from TradingStrategyGuides.com. Thanks for coming back for this installment of our Trading Education Series. In today's video, we're going to discuss multiple time frame analysis. Not only does the name sound cool, but it's not very hard to do. And after this video, you can tell all your friends that you practice multiple time frame analysis and they'll be suitably impressed. Multiple time frame analysis is a method of analyzing the price action starting from the larger time frames and coming down to the smaller time frames. In order to talk about multiple time frame analysis, we need to talk about trends and how to combine trends, because multiple time frame analysis means that we use different time frames to gauge the market trend. For example, we're going to use the daily time frame to establish the bigger trend, and we're going to combine that trend with what's going on in the 1 hour time frame and maybe even the 5-minute time frame to fine-tune our entries. It's a straightforward process if you follow the rules. It's very much a top-down approach that can help you focus on the big picture trend and trade with the prevailing momentum, taking into consideration what transpires on higher time frames. And if you've day traded on very short-term time frames like the 1 and 5-minute charts, you know you'll quickly lose track of the big picture if you don't periodically check the higher time frames. In technical analysis, the daily time frame is regarded as one of the most important time frames because the big guys, sometimes known as the smart money, usually operate on these bigger time frames. So no matter what your preferred time frame is, when using multiple time frame analysis, the daily chart should be part of your study. As a general rule, higher time frames have more significance than lower time frames. The multiple time frame analysis approach has the benefit of offering you clarity on the trend direction and where the market is going. If your preferred time frame doesn't present a clear trend, then by using 1 or even 2 time frames in confluence, you can more easily figure out the dominant trend. When using the concept of multiple time frame analysis, you will want to have 2 confluences between a higher time frame and your lower time frame to give you the best possible entry. This is how we pick our entries to reduce our risk and maximize our potential reward. We don't want to fight the higher time frame and the lower time frame unless you're using a counter trend strategy that has a proven edge. Everything that happens on a higher time frame will affect your trade even on the 5-minute chart or the 1-minute chart, so we have to be aware when we're getting near key daily and weekly support and resistance levels. Each time frame has relevance within each other, but the lower we go in the time frame, the more noise that we'll get when we're trading. Here are the steps to the top-down approach to multiple time frame analysis. Step 1. Start from the weekly time frame to get a general market overview and establish the long-term trends. We'll start out on the weekly time frame just to get a general overview of the market, where it is, and whether there are some important support and resistance levels ahead, as well as other things that we need to be aware of. We try to establish the general supply and demand balance and who is really in control of the market. Here we have a Great British Pound USD weekly chart which found a bottom at the beginning of 2017 and has been trading higher ever since. However, this rally is just a retracement within a larger downtrend that can be observed on the weekly time frame. Now, on the daily time frame, we look for directional clues and draw support and resistance levels. Using the daily time frame, we get more specific, making it perfect for determining the long-term trend and other important price action patterns. The second step is to apply the principles you have learned throughout the support and resistance module. You need to analyze and draw the levels of support and resistance in the bigger time frames. Spot those areas and levels in the daily and weekly time frames as they carry more weight there. On the daily chart, we can define the daily trend, which is effectively moving against the bigger trend. But this is good because now we can look at possible resistance areas from where we can expect a reversal in the direction of the weekly trend. In this case, we can already spot a bearish engulfing price action on the daily time frame that can be our signal for entry. However, if you still want to fine-tune your entry, you can downgrade your chart to an intraday time frame for a better entry level. Which brings us to step 3. come down to the 1 hour intraday time frame to establish a trade scenario and fine-tune your entry. Using the 1 hour time frame, we attempt to establish a trade scenario and build a framework around a trade idea. The analysis must always be conducted with the larger time frame in the back of your mind. Here we have to wait for a reaction at these support and resistance levels that we previously drew. In our case, we're looking only to trade short at resistance because we want to trade in the direction of the larger trend. It's up to you how many time frame confluences you need to establish a trade, but be careful not to get caught up in analysis paralysis. Sometimes you can be fine with just 2 or 3 time frames, but other times it might require going deep into the very short-term time frame, like the 5-minute or 15-minute time frame, to fine-tune your entry point. You can also zoom into your preferred short-term time frame if you feel more comfortable with one particular chart. Remember, as a general rule, you want to include your preferred time frame in your multiple time frame analysis, the time frame where you have a more intimate understanding of the price action. As I've said many times, everyone has a different trading style and will therefore be more comfortable using different time frames. As an example, if you're a short-term trader that trades off of the 15-minute time frame, you should use the 1 hour chart or the 4 hour chart as an intermediate time frame to determine the market trend. With that said, I highly recommend you use the daily time frame. That could be considered the big daddy of all the time frames. Like any trading approach, multiple time frame analysis is not infallible, as most successful trading is what's between your ears. Psychological. An effective multiple time frame analysis uses at least 2 time frames, one higher time frame used for determining the trend and one lower time frame used for timing the market. In other words, we're picking our trade direction on a higher time frame than the one that we're going to use for our entries. We have to seek an alignment in multiple time frames if you want to understand what really happens behind the price and ultimately to become a successful trader. And that's it for today's video. Next week, we're going to look at different trade setups. Come back Friday for my strategy of the week and next Monday for my trade pick. And don't miss the next installment of the Trading Education series next Wednesday, when we'll discuss the whole process of trading. My videos come out at 3 p.m. New York time on those days. Don't hesitate to ask any questions you may have. Remember, the only stupid question is the unasked one. If this video helped you, smash the like below. Subscribe and hit the bell if you want to be notified of our videos in the future. Have a great hump day this week, and I'll see you on Monday.